Hi, everybody. My name is Buck Hartzell, and I'm joined today by senior analyst Nathan Parmalee. Nate, thanks for coming today.
Thanks for
And
having me.
our real guest, our special guest, is Pedro Arndt. He's the CEO, Chief Executive Officer of dLocal, which is a company out of Uruguay that is doing some, we think, some wonderful things in transactions and payments in emerging markets. Pedro, thanks for joining us today.
Thanks for having me. Pleasure to
Oh,
be here.
well, it's great, and I'll tell you this: I am a longtime shareholder of Mercado Libre, and so I followed that company for a long time. We had looked at dLocal a couple different times, and when you moved over from Mercado Libre, that is a big part of our investment thesis. So thank you for the great job you did at Mercado Libre, and also I'd say that's worked out so far very well for members. I think we're up 39% since the recommendation, so it's done very well. And I just say we've admired your career, and we're happy you made the jump. My first question is going to be on, you were at Mercado Libre a long time. You had a very successful career there. What attracted you? I'm sure you had other offers. What attracted you to dLocal?
So I think it was a combination of two things. First and foremost, the opportunity to somehow find something that had as much growth potential as the journey I had been on at Mercado Libre, but that
Yep.
this time had what I consider global reach. dLocal is not only LATAM, it's increasingly more and more also Africa and Asia.
Yep.
And the second piece, somewhat related, but not necessarily the business opportunity, but the earlier stage, which was about once again building and designing solutions at a smaller scale,
Yep.
was also attractive for me in terms of professionally. I feel that this stage of company building out is the one that really is where I both enjoy myself the most and where my skill set is best put to use.
Yep. Well, that's great. And you do know a thing or two about building scale. You certainly did that already, as you mentioned, at Mercado Libre. When you first came over to dLocal, we're going to start with some cultural questions. I'll just say that's something we care a lot about as a company, and I personally do as an investor. One of the great business minds and thinkers was Peter Drucker, and he had a great quote that I love that says, "Culture eats strategy for breakfast." And so it's something that we care a lot about here. You originally came over in the co-CEO role, so you were sharing duties, and that didn't last very long. You kind of just assumed sole responsibility for CEO. So what was the goal of the initial structure, and then why was the decision made to go to you solely as CEO?
Yeah. So I actually think that that's quite an interesting, and I would say, as the person who was stepping into the challenge, a successful transition model. So that was planned all along.
Okay.
We didn't improvise that. That was always the idea. And it has a lot to do with culture. I think there's a recognition that when you're bringing someone from the outside, it's generally about giving that new entrant that time and that shadowing of the outgoing CEO, in this case also a founder, which
Right.
from a cultural perspective, typically, certainly in my case as well, are very big shoes to fill. The time to spend together so that I could see how he did things,
Yeah.
sort of the cadence with which he managed the organization while he was still there. And then at the moment we felt that I had understood enough and spent enough time with him where it was my turn to sort of continue everything that worked about the dLocal culture and ideally be able to add some of my own imprint to that, then that was the moment that he fully passed on to the board role.
That's great, and I love to hear that. Long ago, we interviewed the founder of Rackspace, and they grew really quickly, and they hired a lot of people from the outside. And what they found after a while is it almost broke the machine because they put these outsiders in this unique culture, and they started doing things that were kind of counter to some of the things that they held dear. And he said that they changed, and what they decided was any of the outsiders, they couldn't have anybody report to them for 6 months, and then they would change things up, and they could kind of assume stuff. So I'm happy about that transition plan, and it makes a lot of sense for me, especially with the founder-led culture. Yep. So another question for you. When you get inside a company, it's different from what you see from the outside. What was a pleasant surprise that you learned about from dLocal once you got inside the walls and started meeting the people and understanding those processes?
There were always, I think, you're going to find things that pleasantly surprise you, and you always find some things that perhaps
Yes.
you weren't expecting, right? But
Yep.
in this case, there were two that I knew were an essential ingredient of the company, but I actually found that they were even more powerful once I was there. And the first one is the focus, the real, because all organizations say this, but the real merchant focus. I mean, the way product was developed, the way that most internal processes are set up, they really try to work from the merchant backwards. A lot of the reason why we win is because we really do a level of bespoke enterprise payment solutions that really understand the particularity of the merchant's business and the market that we're building for. And that really is, I think, one of the superpowers of the organization. And the second one was just the size of the opportunity. I don't think until you actually start dealing with payments and financial infrastructure across these 40 plus emerging markets, you don't appreciate how truly complex and different each market is. And that's exactly what we solve for, right? We allow our global merchants to not have to solve for every single emerging market, set up a local payments team, and have to navigate each one of these markets, but rather we abstract all that away for them. They connect into us once, we do all the heavy lifting. And it actually is significant heavy lifting once you start understanding each market and its particularities.
Right. And we're going to get in that kind of foreshadows a question that's coming up pretty shortly. But I want to get two more in. I'm going to do one, and then I'll hand it over to Nate for one as well. You mentioned there's challenges and pleasant surprises. What was one of the challenges that you found when you arrived?
Yeah. And I think that challenge was a direct consequence of the company's success. So it's interesting in that it wasn't anything that was necessarily a mistake, but 2026, so next year, will be our 10th year anniversary. So that's how young this company is, right? So I arrived about 2 years ago. So that was an 8-year-old organization that had already expanded to 3 continents, had already IPO'd, right? And therefore it had taken on a significant amount of business complexity because of the sheer pace at which it has been growing, and it continues to compound growth at an accelerating level today.
Right.
And that meant that we really needed to, on the fly, as we continue to serve our merchants, as we continue to grow at these very high levels, also build foundational blocks so that we could 10x from here. Where in many companies' cases, you don't really hit market 41, 42, 43 until maybe you're a 25, 30-year-old company with a lot more of those foundational blocks already in pace. So it really has felt at times like the age-old adage of building the plane while you're flying it.
Right. Yeah. And then it's hard. I mean, I remember the Motley Fool. We went international as well. Nate knows this. We work on Canadian services, and each of those additional countries you add adds a layer of complexity around compliance and all those other things that you have to deal with that are big. So that's
cultures too.
Yeah. Yes, cultures as well. Absolutely. We went into Germany. We're telling jokes in Germany. Turns out Germans don't think money is funny. So it's like we have a sense of humor about our brand. That's the way we talk to people. Germans didn't like that very much. Yeah, right. Right.
As a minority, yeah.
Yeah.
I was just curious, kind of overarching, as you have entered new countries and new markets, how important is it to replicating your past success? That you're able to identify people as you enter new markets with the skills and traits that you need, and kind of how do you go about that? How do you solve for that? It must be difficult going from, say, Latin America to Asia and trying to replicate what you've done.
Yeah. So it's a great question. The answer I would say is somewhat counterintuitive. And there's a reason why dLocal has been very focused on its mission to enable payments and financial infrastructure across what we call the global south, so
Hmm.
emerging markets. And we have steered very clear from trying to offer our services in emerging markets, sorry, in developed markets.
Yeah.
Because you could say the temptation is once I have that enterprise customer, whether it be Netflix or Google or Amazon or you name it, why not try to sell to them in the developed world as well? And the reason for that is that, interestingly enough, there are commonalities between payment ecosystems across most of the emerging markets. They're fragmented, they're characterized by a lot of local payment players, a lot of legacy technology. And once we realized that is when we said, hey, the path of most Latin American companies is to become a regional champion. That was the story with Mercado Libre. But there's enough in common with Africa as well that we can take a lot of these learnings and these key success factors that make us operate so well in Peru and Ecuador and Costa Rica. And that also applies in Egypt and Kenya and South Africa. And then eventually realize, hey, the Middle East is not that different. And by the way, there are most pockets of Asia are not that different either. And so I'd say it's been more a story about commonality and being able to port over what we learned as we grew in Latin America to the rest of the world. And then selecting people and finding the right capability sets. I think that's just the common I think key element of scaling any story, right? These are not physical world assets. This is a bits and bytes business, extremely scalable, very attractive from a financial perspective. In that sense, quite easy to replicate internationally because we're just lines of codes on servers that in many instances don't even have to be hosted locally. What we need to have locally are the feet on the ground on behalf of our merchants. So who we
Right.
hire at the end of the day is the key asset into each market that we go. And it's just a matter of making sure you get that right. And when you don't, to be able to switch up quickly.
Yep. And that's a great segue into the kind of from culture to business for us because we were really kind of getting into the business part earlier. But you know what I've learned, I've been here at the full 27 years, is that most great companies that are growth stories, they solve a migraine level problem, to borrow from my colleague Tim Byers. And you got into that a little bit. You mentioned you serve some very large technology partners. We're talking about Amazon and Alphabet, Spotify, and you named a few others. They've chosen dLocal. Can you explain the problem, like to our listeners, to maybe some people who aren't experts in the payments business, to like how is dealing with dLocal? How does that remove a pain point and a problem for the Amazons of the world, which seems like that would be hard to do?
Yeah. So I think the key words here are fragmentation and localization. And what do we mean by that? So, first of all, when you think of the developed world, when you're going to buy a product or a service online, 9 out of 10 transactions, more significant, like almost all of them, will happen on a credit card. And when you look at the performance of credit cards in the developed world, it's actually pretty good. You have over 93, 94% acceptance rates.
Yep.
When you move to the emerging world, that changes dramatically, right? Just to start off, over half of the economies still run on cash.
Yep.
And when you move on to the digital world, it's not that half is on cash, because cash is a horrendous user experience, although it is a big part of what we sell. But you have this highly fragmented space where you have alternative payment methods, digital wallets, bank transfers, real-time networks that have emerged across the global south. And so And more importantly, it's not like you have one digital wallet that spans 15 markets. These things are typically quite local. So
Right.
if you're a global merchant and you actually become serious about your go-to-market strategy across emerging markets, you typically have a fairly scalable product. If you're a content streaming company, you have all this content that you can sell across all of Africa, I would argue at very low marginal cost, because you're just streaming your content to Nigeria, to Kenya, to Morocco, to Egypt, to South Africa. But where it gets tricky, and it's been a significant growth pain for most global merchants, is how do I actually collect for my service? Because every payment ecosystem in every market is different. So
Yeah.
if they had to go and solve this over and over and over again, that would probably imply a team per market that they have to solve.
Yep.
What we've done, and there's some aggregation theory here, is we'll go into Nigeria and we'll solve it once. And then we'll turn around and we'll sell that solution to all of our merchants.
Right.
So from our perspective, we're aggregating volume, we're solving once, we're solving it really well, and then
Yep.
that solve we can offer to hundreds of global merchants. From the merchant's perspective, it's one integration into dLocal, it's one point of contact, it's one set of integrations for my back offices and my middle offices. So reconciliation, integration into my ERP, etc. And then expanding into an additional market is literally a few lines of code.
Right.
And
Yeah.
that's incredibly powerful for
That
them,
is, yeah.
rather
Yeah.
than having to deal market per market.
Yeah, that's excellent, and that explains it really well for people and what you're doing. Now, I'd say like when you work in emerging markets, there are some unique risks that are different from the developed world. We've seen most recently there was volatility in Argentina, where the peso has been devalued and those kind of things. What are some of the unique risks and opportunities that you see in when you go into Egypt or some of these other emerging markets?
Thanks for that. So I've been wanting to use this common Silicon Valley phrase for dLocal for a while.
Okay.
You've given me a chance for it to be the maiden attempt. So
Okay.
what I think sometimes investors need to understand is that the volatility is not a bug, it's a feature here. And
Okay.
what do I mean by that? It's exactly that inherent volatility. So FX volatility, regulatory landscape that is constantly evolving and changing and complex, changing and fragmented payment landscape that I said. That's exactly what makes our service so valuable. If all of these emerging markets were not volatile, they were very consistent and they were fairly unique, then there really wouldn't be a need for what we're doing. So the more volatile it
Yep.
is, the more shifting it is in its nature, the more value we're adding to our merchants. Where
Right.
does that volatility come in? I think I've mentioned them. There's always FX exposure. And so a big part of the solution that we offer, and I hadn't mentioned that, is managing that FX volatility and hedging that out for merchants.
Oh, great. Yep.
There's regulatory, I don't know if the word is volatility, but complexity in that, and this is true, I think, for developed world as well, as we see so much innovation occurring in payments. But these regulatory landscapes haven't really been built for the world of fintech, for the world of crypto. So they're
Yeah.
constantly evolving and changing, much more so than the developed world. And so keeping abreast with those regulatory frameworks to make sure you don't trip up, interacting with the regulators to advocate on behalf of these global digital merchants, all of that is part of this shifting landscape that generates opportunities, but also generates that constant volatility that, quite frankly, sometimes public market investors, I think, need to make sure that they understand well and that they're comfortable with the company that they've invested in that can navigate that well.
Right. Yep. Absolutely. And emerging markets, they're different. And you mentioned this already. You talked about cash. A lot of these people that you're serving that want to make the transactions, the purchasers, they may not have a credit card, for instance, right? It's a very low credit card penetration and stuff. I'm interested to hear more about how you're serving those people who want to purchase the services from your big clients and how you're seeing their forms of payments evolve. Because I've said to folks here at the Fool, like in the next 5 years, we're going to see more changes in the payment system than we saw in the previous 50 years. Like it's evolving that quickly. So what are you seeing as a push from customers and consumers that's changing on that landscape?
Yeah, and we already see that across the developing world, right? So what's the starting point? Call it 10, 15 years ago. Is whereas in the US, everyone had a bank account and everyone had a credit card, or in Canada or in Europe. In emerging markets, most people didn't have bank accounts. They were either non-banked or underbanked, right?
Yeah.
Mhm.
And existing financial institutions found it very hard to reach that population, or because these are lower average revenue per users, were less interesting given the traditional bank cost structure and typical business model. And so that generated this enormous space for innovation. Those digital companies that could reach this mass of emerging consumers who wanted financial products but didn't necessarily have deep banking relationships, were able to reach them thanks to the cell phone, right? So you have the emergence. It's not a coincidence that the world's largest neobanks are from Latin America, that the world's largest digital wallets are from Asia, that the world's first and most innovative mobile money emerged in Africa, that some of the world's leading buy now, pay later credit offerings are in LATAM and Africa as well. It's because consumers were able to access financial inclusion for the first time through these neobanks, neo-lenders, and digital payment services, right?
Yep.
And so, but again, that's what generates the need for a dLocal. It's that these consumers don't want to have to pay with a credit card. Most of them, like you said, don't even have a credit card, or if they do, they really don't use it that much. It has a low credit limit. It's just not the way they want to pay. The way they want to pay is with M-Pesa in Kenya, it's Mercado Pago in Argentina, it's Pix in Brazil, it's UPI in India. And what we do is we integrate all of those technologies into our global merchants checkouts, and we are experts in making each one of those payment methods work well. What does work well mean? High conversion rates, low latency, redundancy, and everything that goes into making payments work the way emerging market consumers want to pay.
Right. Yep. That's great. As we look at the future, so if we look 3 to 5 years out for dLocal, what is your biggest priority for a growth standpoint? Is it adding new markets? You mentioned kind of moving into new markets with a big boatload of customers you already have, or is it adding more customers to do more business in the markets that you already do? What's your biggest focus?
Yeah. So I get this one all the time, and it's almost like choosing your favorite son or daughter, right?
Right.
And the
Yeah.
reason for that is that we have all of these growth vectors. So the first one is simply our existing merchants. If you take our top 50 merchants, on average, they still only use us in about 11 markets. We offer 43.
Okay.
So as we prove the power of what we do to them on those on average 11 markets, and I think the one that most markets has is probably in the low 30s now, right?
Okay.
And that's the trajectory we hope to see all of
Yep.
our merchants undertake. So we have significant wallet gains and volume gains with our existing merchant base. And that has been the biggest driver of growth if you look at any quarter, right?
Yes.
But on top of that, the truth is that when I look at merchant adoption of localizing payments, we're still in the very early days. So it's only today the really large global merchants that have gotten to a point with their go-to-market strategies across emerging markets where they said, okay, my business is now large enough in Africa or large enough in LATAM or large enough in the Middle East or Asia that I want local payments. The vast majority of global digital markets are still fine using international credit card acquiring. And so that means that over the next 5 or 10 years, we're going to see a massive growth in the number of merchants we serve. We still serve less than 1,000 merchants.
Okay.
There's no reason that number can be in the tens of thousands if you take a 5-year view.
Right. Yeah.
And so that's why I think this has so much tailwinds and there's still so much run rate for our growth story.
That's great. And I want to ask a follow-up question because it's a little bit of a Nate, you're next up.
I was gonna say
So,
I have two now, but yeah, go ahead.
okay, that's all right. Maybe when,
One's quick.
when you do more business with that merchant, so if they're in 11 markets with you and they go to 12 or 13 or 14, the reason why I want to be this is because I think some of our investors are sensitive to it. Does that mean generally when they do more volume that you're going to have lower margins with that client?
Yeah. So the answer inevitably is yes,
Okay.
because it's a basic principle of a commercial relationship. The more volume you give me, the more business you give me, the better I can get pricing for you, because I'm also driving down cost, and because that's the nature of attracting more volume. And that's why we always say that we're fine with take rate as a modeling tool for investors, but
Yep.
that companies typically manage businesses for gross profit dollars, and therefore for EBITDA and earnings, not
Yes.
for a take rate. A take rate is an output of grabbing my revenue and dividing it by my payment volume. At the end of the day, if I can serve a merchant in a market in a profitable way where I'm adding gross profit dollars, and that's strengthening my relationship with that merchant and generating more scale for me, then I will do that willingly,
Yes.
regardless of what it does to the take rate equation.
Right. Yeah. And I've said that with folks that said, hey, when you think quarter to quarter, what are margins going to do? I'm like, we're not really looking at that. We're looking at more at volume than we are at margins for that very reason. All right, Nate.
Yeah, and sorry, and just one thing that for me is important. It's not, I would argue, it's not really margins. Like margins in dLocal over the long term will expand. Like I said earlier, this is an asset-light business. It has significant operational leverage built into the financial model. Right now, we're kind of leaning into the business because we're building a lot of things. So margin in terms of EBITDA margin and net income margin, I think as we grow, will continue to scale and to improve. It's the take rate issue that I think investors have erroneously focused on too much, which is essentially revenue divided by TPV, where what we're looking at is how many gross profit dollars am I generating from all of these new contracts that I'm signing.
Okay. Yep.
Makes sense. I was just curious, as you win a new customer, do you find that they often say give you one market or even one type of transaction that they handle first and see how it goes, and then there's growth from there?
Absolutely.
Or does it? Okay.
No, absolutely. And if you look at ramp-up phases, and you can see this when you look at our cohort data on a yearly basis, year one of a merchant is typically not a year where they actually have a material impact on our results, no matter how big the merchant is, because they've typically started with one or two payment methods in one market. And then when they see that that works, they'll add some more payment methods and they'll ask for a second market. And then there really is a tipping point where there's a point where the relationship works very well, they trust us, they go into a phase of rapid emerging market expansion. And then you have these merchants within the cohorts where we're literally adding maybe 7, 8 new markets and 4 payment methods per market in a single year. So there's a long sales cycle in this business because it's enterprise sales. And then even once you convert the merchant, there's typically a fairly long period of ramping up. And then 2, 3, 4 years out is when you really begin to see that merchant's impact flow through our P&L.
So for our Canadians, kind of like a hockey stick of sorts.
Perfect.
Yeah.
Indeed.
And I had another question too about competition, because I'm aware of a couple of competitors who are from developed markets. That's where they started. But they've offered kind of a similar service in emerging markets with multiple payment types and cryptocurrencies, et cetera. But again, they're kind of approaching it from the outside in versus being based in an emerging market and having kind of always lived it, and that's your core. I'm just wondering, how often do you bump into them? How or do you not? And it's more kind of small local competitors that you bump into more often.
Yeah. So I think you have to sub-segment our geographic footprint to get that answer. And I'm not going to tell you there's 42 answers. I think it's simpler than that. There's probably 2 answers. There are some markets that we offer, the really large ones, certainly Brazil and India, and you can make a case for Mexico because of the proximity to North America, where we do compete, and we have competed for a while now, even with the Adyens, the Stripes, Nuvei, right? And we've done phenomenally well in those markets. We actually think that given most of the publicly available market data, we're probably share gainers in those markets because that's our home turf. That's what we're exclusively focused on. For many of these companies, which by the way, we admire and we think are phenomenal companies, their businesses in North America and in Europe are so large that the emerging market component is a little bit of a small segment, whereas for us, it's full focus. But more importantly, when you move away from Brazil, Mexico, India, then you start getting into a real fragmented tail of markets where when you look at size, the next ones are Argentina, Colombia, Nigeria, South Africa. Now, the cost of setting up a credit card acquirer in any of these markets is really the same as setting it up in the US or Germany. The size is significantly smaller. So when you get to all of those markets, which for us still already represent more than half of our business, there you're not coming across these developed world giants. There you're typically coming across either companies similar to dLocal or local or regional payment companies. And that's why we stress so much the importance of the concept of the one dLocal API and the 45 plus market reach, because that's really the power of why we win so often. If the merchant then needs to go and choose one for sub-Saharan Africa, one for Southern Africa, one for the Middle East, one for parts of Asia, one for Central America, that also gets complicated. We give them pretty much the entire emerging world in a single integration, which is something a Stripe, an Adyen, a Chase Payments, and Nuvei don't really give you.
Yeah, that's excellent.
Excellent. Yeah.
I want to go now into capital allocation, and building for scale is something you're really good at, something you mentioned as like a really important thing. You don't have much in the way of capital expenditures. So maybe can you tell our listeners and shareholders, like what does investment entail at dLocal? Two that come to mind are people and technology, but maybe you want to expand upon that and tell people like where is dLocal investing and what are they investing for?
Yeah, and you hit it right, spot on. And that's the beauty of this financial model when we think about it long run. And that's why I said, look, we're leaning into the business right now. So you haven't really seen that much margin expansion. We still have very healthy margins. But if you understand the nature of this business, which is a non-physical world asset business, it's incredibly scalable from a margin perspective. And that's because really our expenditures are human capital, as I mentioned earlier. And even when we say technology, sure, I mean, we have a huge AWS and GCP bill, but that scales quite nicely. It's really about the size of your product and engineering team so that you can continue to innovate on behalf of your merchants. And so when we talk about an investment cycle, sometimes I think that conjures up these notions of, these massive CapEx lifts or things like that. Not at all. For us, an investment cycle is, look, we're strengthening different teams, right? So 2 years ago, this company had 200 engineers. It's now above 600. That allows us to accelerate our new product roadmap. It allows us to get better and more innovative at driving improved conversion. It allows us to have more engineers working on low latency, on building integrations so that every single payment mechanism has fallback and redundancy, and to enter new markets quicker. But for us, it really is primarily about human capital and potentially about technology services that we use. And beyond that, all the expenses are quite manageable and scale quite well. And even those two, once we decide that we've already played catch up and that it's now time to reap the rewards from having grown that engineer base, from having built all this AI and automation, At that point is when you begin to see an acceleration in margin expansion.
Yep. And are those engineers, I know this is a Uruguayan company, are they in South America, or is that something where as you expand and you go from 200 to 600, that some of them are in the markets that you serve? How are you organized from that
Yeah.
standpoint?
So the beauty of Uruguay, and I think it's part of the secret sauce of dLocal, since the founders are from here, is it's one of the smallest countries in Latin America. It's also one of the richest and the most stable. But that means that you can't really conceive of an ambitious project if you think you're just going to stay in Uruguay. And that's what pushed them from very early up to think globally. Because if you're a Brazilian entrepreneur, your market is so gigantic, or Mexican, you could very well conceive of your endeavor as always being local. The same goes for engineering talent and human capital. I mean, we wouldn't be able to source effectively in the market given how small the market is. And so we're a highly distributed organization. And that's what served us very well once we began to really grow nicely in Africa, in Asia, in that we were kind of already set up to chase the sun from a customer perspective. And so the way we're organized is interesting. Our sales force and our merchant-facing organization is separated by US, EMEA, so mainly Europe, and Asia, with a focus on China, because that's where most of our clients are. We have over 100 people in Shenzhen and Shanghai to serve Chinese merchants.
Okay.
And then our operations teams have to be in the markets where we're actually processing payments. So throughout Latin America, throughout Africa and the Middle East, and throughout Asia. And that's exactly how we are. We try to be both close to our merchants and certainly close to the markets where we're processing payments.
Right. And that makes all the sense in the world. Now, we're on the capital allocation here, and you made an interesting decision recently to return 30% of the free cash flow from the previous year in the form of a special dividend. dLocal is a growth company, very low CapEx, and has a history of generating a lot of cash. Historically, a good chunk of that's gone to buybacks, and I'm just interested to hear on how that decision was made and what are the other things that you considered when you announced that, hey, going forward, we're going to pay out a big chunk, 30% of our cash flow in the form of a special dividend.
Yeah. So the first thing is, like I've been saying, this is a very cash generative business model, and we see no reason why it won't continue to be a cash generative financial model going forward because of all the reasons we've just covered. Right. And as a board, we didn't think that it made sense to fall into these, let's just accumulate all this cash on the balance sheet for a rainy day. Like, we can still do that, have a prudent reserve, and yet when we look at the business, it's going to generate cash in excess of that. Right. And so 30% of the free cash generated, we feel very comfortable is still prudent stewardship of the company to return that to shareholders. Yep. So then the question becomes, why the dividend and not necessarily the share buybacks? And I think there's two reasons for that. The first one is this is a stock that will benefit from increased liquidity. The actual free float, I think the bigger it gets, the better it'll be for trading pattern. So we didn't want to continue to take shares out of the market because liquidity is an unlock for us. Yeah. And then the second factor is share buybacks. If you're going to do them well, there has to be an element of where your stock is, right? I would argue right now I'd be buying dLocal like crazy. The board would probably be supportive of that. But that's not necessarily always going to be the case. Whereas a cash dividend payment is a very predictable way of returning cash to shareholders that you can telegram in advance and you're not really going to get it wrong. So the way we think about the capital allocation now is the 30% is a good indication of how much of the free cash flow generated will go back to investors. It's in the form of a dividend policy. If at any point we feel the liquidity issue has been solved and that the share buybacks may be advantageous to investors for whatever reason, I think it's a fairly easy shift to say, hey, we're going to use the 30% for buybacks and not dividends, but we're sticking to the discipline of you knowing that it's a third of the free cash flow every year.
Yeah, that perfectly answers the question. And I'm quite frankly shocked that more companies don't do a similar thing on special dividends where there's very little, and particularly in businesses unlike yours that are volatile and move up and down and have commodity exposure and all that kind of stuff. Well, that's awesome. We're going to move to the last fave now, Pedro, and this is something we call buy, sell, or hold. This is kind of the fun portion, so it's not always going to be about dLocal, but we hope you enjoy some of these questions that we've put together. You just tell us your quick take, buy, sell, or hold on what the individual item is. The first one is, looking into the future, are you buy, sell, or holding paper currency throughout the world, including the US dollar?
Shorting it as fast as I can.
Yeah, okay, great there, great. Do you want to add any context on that other than deficits
Look,
and everything else that go along with it?
Exactly. I think the future is digital. Digital will have multiple aspects to it. The most obvious one is simply your cell phone as a wallet and you're moving digital currency around. And I think increasingly the underlying infrastructure of finance will be the blockchain. And so at that point you start having, the US backed tokens. You start having, we already have those with USDC, USDT and the likes, but I think many currencies globally will move to central bank backed digital currencies, and that'll only make my short on paper money even more obvious.
Okay, that's great. Well, it kind of leads me into my second one. Cryptocurrency will significantly disrupt the way people buy and transact goods today. Or you buy, sell, because very little goods and services. If you look at the percentage of goods and services,
I'll give you the answer. I'm a hold, but I'm a hold not because I don't think that is the future, but I think like so many of these things, it ends up happening. It just takes a little bit longer than our initial euphoria sometimes anticipates.
Okay.
I think eventually we get there, but the truth is that when you look at digital money, not necessarily crypto, it's actually working really well for us. I mean, paying with a credit card or paying with my cell phone on a digital wallet, it's a pretty painless experience.
Right.
And it has chargeback management. It has cashback, loyalty points, bonus points. So I don't know that consumers, and especially not in most emerging markets, are dying to do away with the way they pay today to migrate to crypto-based payment. Over the long run, I do think it's a superior infrastructure and we get there, but maybe we get there in a different way than we imagine right now.
Okay, great. That's a hold. This is the last one, and it may seem a little bit out there. Buy, sell, or hold the fact that humanoid robots will one day have their very own credit cards so they can go out on our behalf and purchase goods and services for us using dLocal, of course.
Yeah, that's a buy, and I don't think you need the humanoid robot because I don't think physical space in the era of agentic commerce payments and e-commerce will be necessary. So you'll just set up your agent on Mercado Libre. The agent will know what you need, will know that you've run out of milk because that's your normal morning breakfast cadence. It'll go over to Mercado Libre. It'll use a commerce protocol that it pings dLocal on. Your milk will get ordered and sent to your house. And that's like, the more you look at the technology, I actually think that actually adds more value to a consumer than going from a credit card payment online to a crypto-based payment online.
Okay. Yeah.
Agentic, I think, purchasing agents really do add value. So that one, to me, potentially catches on faster.
That's great. There you got it. Yeah. So on behalf of Nate Parmalee, myself, Buck Hartzell, we thank Pedro Arndt for taking this time to educate us on dLocal. For all you investors out there, this is on the NASDAQ, ticker DLO, dLocal. Thank you once again, Pedro, for sharing your time with us. We really appreciate it.
Yeah,
thank you. I'm a big fan of the stuff you guys do, so thank you for this opportunity.